Imagine waking up tomorrow morning, opening your banking app, and the screen just reads zero. Not because you spent anything. Not because of fraud. Because the bank itself is gone. Most people think that's impossible. History says otherwise, and it's happened more times than you'd ever believe. Today, we're pulling back the curtain on something almost nobody talks about: what actually happens to your money when the financial system collapses. Not the dramatic movie version. The real version, backed by history, economics, and the cold hard math of how modern banking actually works. By the end of this video, you'll understand how your deposits can vanish overnight, why governments lie to protect the illusion of safety, what people in Cyprus, Greece, Argentina, and Lebanon learned the hard way, and most importantly, what you can actually do about it before the next crisis hits. Because one thing history guarantees? There will always be a next crisis. Here's something your bank will never put in a brochure. The moment you deposit money, it is no longer legally yours. You've become an unsecured creditor. The bank now owes you a debt. It doesn't hold your cash in a vault with your name on it. This is called fractional reserve banking. Banks keep only a tiny fraction of deposits on hand, historically 10%, and since 2020 in the United States, the legal reserve requirement dropped to zero. That means your bank could, in theory, lend out every single dollar you deposited. When you want your money back, they're counting on the fact that not everyone asks at once. What happens when everyone asks at once? They call that a bank run. And it has destroyed more families than any stock market crash in history. After the Great Depression, the U.S. government created the FDIC, the Federal Deposit Insurance Corporation, to prevent another bank panic. The idea: if your bank fails, the government guarantees your deposits up to $250,000. Sounds bulletproof, right? Here's what most people don't realize. The FDIC fund currently has enough money to cover roughly 1.2% of all insured deposits. 1.2%. If multiple large banks failed simultaneously, the way they did in 2008, the way they nearly did again in 2023 with Silicon Valley Bank, the fund would be wiped out within days. The government would then face a choice: let depositors lose everything, or print more money and trigger inflation. Neither option is painless. Both have happened before. In 2012 and 2013, the small island nation of Cyprus taught the world a brutal lesson. Facing a complete banking collapse, the government and the European Union agreed on a bail-in. Instead of using taxpayer money to rescue the banks, a bailout, they took money directly from depositors. Accounts holding over €100,000 lost nearly 47% of their funds. Overnight. Without warning. People went to ATMs and their balances were just smaller. What's chilling is that this wasn't a fringe economic event. The European Union explicitly called this model a template for future banking crises. The United States has similar bail-in provisions buried in the Dodd-Frank Act. This is legal. And it has already happened in living memory. You don't need a dramatic collapse for your bank account to lose value. Inflation does the same thing, slower and almost invisibly. In 2021 and 2022, inflation in the United States hit 40-year highs, over 9% annually at its peak. Meanwhile, the average savings account paid 0.06% interest. Do the math: if your money earned 0.06% but prices rose 9%, you lost roughly 9% of your purchasing power every single year. Every year. No headlines. No panic. Just quiet erosion. This is the pattern throughout history. After World War II, Germany's hyperinflation made wheelbarrows of cash worthless. In Zimbabwe in 2008, the government printed a $100 trillion note, which couldn't buy a loaf of bread. In Argentina today, annual inflation runs above 100%. The mechanism is always the same: governments facing debt print money, money loses value, savings are destroyed. The names change. The playbook never does. In the 1930s, a bank run required panicked crowds physically lining up at the doors. It took days to develop. In 2023, Silicon Valley Bank experienced the largest bank run in American history, $42 billion withdrawn in a single day, almost entirely done via smartphone apps and online portals. No crowds. No visible panic. Just a quiet digital avalanche. What happens next is surprising. Regulators didn't see it coming. Social media accelerated the fear faster than any mechanism regulators had prepared for. One viral tweet can now trigger a bank failure in under 48 hours. The system was not built for the speed of modern information. And that gap, between how fast panic spreads and how slow institutions respond, is one of the most dangerous vulnerabilities in the financial world today. If you want to understand what a true system failure feels like for ordinary people, look at Lebanon. In 2019, Lebanese banks quietly began restricting withdrawals. Then limits got lower. Then international transfers were blocked entirely. Citizens with life savings in Lebanese pounds watched the currency lose over 90% of its value. Doctors, teachers, business owners, people who did everything right, were suddenly unable to access their own money or pay for basic necessities. The Lebanese pound, once pegged to the dollar, collapsed. Informal black market exchange rates emerged. People who held physical dollars or assets outside the banking system survived with far more dignity than those who trusted the institutions. It is a living demonstration of a principle that every financial crisis confirms: the system protects itself first. Depositors are last in line. History also shows a pattern of warning signs before every major financial crisis. Rising interest rates that banks haven't prepared for, exactly what triggered SVB. Government debt reaching levels where only inflation can solve them. The United States national debt recently surpassed $34 trillion. Rapid credit expansion followed by sudden tightening, the classic boom-bust sequence. Bank mergers accelerating as weaker institutions quietly fail. And perhaps most critically, when governments and central banks begin making emergency public statements that everything is fine. History shows that is almost always the moment to start worrying.